get us going. All right, we are at session 20. Now we're getting into the deep waters of tax analysis, modeling, underwriting, all those fun things. And really in our industry, there's sort of three different tranches. You kind of have personal analysis, then you have business analysis, and then you have sort of what I call income producing underwriting analysis. Those are typically the three different tranches that you walk through. So we'll spend some time. We'll dive into personal tax analysis today, and just start learning about all the fun things when it comes to taxes. So I guess the first thing is tell me kind of just some of the things that you learned, and then we'll just keep pressing into it. So,
well, I guess just like brief overview, the personal tax, it's going to be everything that has to do with the individual. There's a lot of making sure that we're looking at just the individual and not ending up double counting anything that's coming from their business side. I think it's anything that they own 20% of or more, that's going to get wrapped up into their personal. And so you kind of have to go through and sift through those things. And then using their tax returns, we're going to take those to look at their like net worth and their debt service coverage ratio, all those different things to just kind of get a holistic look of everything.
That's great. Yeah, great job. Yeah, it's when you look at personal analysis, personal tax analysis, you're the first thing you're going to look at is the personal financial statement. Okay. Mm-hmm. And in the personal financial statement, we're looking for a couple of different things. Okay. And I'm actually going to pull up one of the ones that we used which will be for, let me just pull this up here. Okay. So when you look at some of these personal financial statement, another way to think about it is really the net worth statement for an individual, assets and liabilities of the individual, and we're looking heavily at their cash position. Okay, we're looking at debts and looking at their cash position. And the reason why is because, as they always say, cash is king. People want to know that somebody has liquidity, that they're fluid, that there is enough money to put down. And then after they put money down, after they buy a building, they're always going to say, what is your post-funding liquidity? Okay. That is a major hot button for most financial institutions, is they're going to say, what is your post-funding liquidity? And what that means is when you get done purchasing the building and you've put your down payment and all the expenses, what are you going to have left? You're going to have zero money left.
Yeah.
Or are you going to have like 6 months of payments? I mean, that's kind of the magic numbers. A lot of times people, because I always ask, well, what's good? I mean, I don't know. And the general rule of thumb is they want to see about 6 months of what the payments would have been for the principal, interest, taxes, and PITI, they call it, principal, interest, taxes, and insurance. They say whatever that payment is monthly, 6 months of those would be good. Okay, so if your payment is $10,000 a month, they'd want to see about 60 grand as post-funding liquidity. That's just like a kind of a temperature check. So you can see this guy, at first glance, you look at it and go, don't have a whole lot of cash.
Yeah.
38,000 bucks is not a lot of money for somebody running a pretty big law firm. Now, the reality is when you do his tax analysis, is he actually makes a lot of cash. He makes a lot of money. You can kind of see his business income is $1,180,000 a year. So when I look at that, you kind of start drawing some conclusions in your own mind. You start asking questions. Okay. So if somebody makes a lot of money and they don't have a lot of cash, there's a couple, what do you think some conclusions could potentially be?
I mean, this isn't a conclusion, but kind of asking like, where is it going? Like, what are you putting it into? And looking at, sorry, my dog just started barking at that moment specifically, but seeing where they're putting that money, looking at, for instance, like their personal residence and seeing how much is going into that, checking their debt to see if they're making like huge debt payments right now. And that's where all of that is leading.
Yeah, spot on. Yeah, no, exactly. Are they just, they have a really expensive lifestyle, right? That's a potential conclusion. Is they just spend a lot of money. That could be one. Another one is, that to your point, they could just be paying down their debt a lot. Okay. Which is exactly what happened with this guy, is he's taking all that excess cash and he's pumping down his debt. Okay. Which is good. He's just paying down debts, et cetera, et cetera. Or they could just have a lot of obligations. They could have tons of debt payments. So those are the three potential scenarios when all is said and done. Actually, there could be a fourth. You could look at his balance sheet for his business, and you could just see that, hey, he doesn't pull a lot of cash through, but he leaves the cash in the business. Okay. So if I don't see a lot of cash on the personal financial statement, a lot of times what I'll do is I'll go to the balance sheet of the company to see, well, do they just leave the cash in the company? Okay. So it's kind of a, could be back and forth, not sure. So that's the first thing you really want to hone in is whenever you look at a personal financial statement, you want to go right to that cash. Okay. And then you start kind of going through those scenarios. The next thing is, and when you look at 401k or retirement, your first knee-jerk reaction, I mean, rightly so, would be, they've got a lot of cash in their 401k or retirement. Okay. Well, yes.
Not like accessible like that. It's not liquid.
It's not liquid. Yeah. The bank has no rights. Okay. That's kind of the nice part about 401ks is the bank legally can never, ever touch your 401k. Okay. So if you went through bankruptcy or got foreclosed on or whatever, no one can ever touch your 401k. Okay. So it's just kind of this protected thing. So you always kind of notice that. It's good to know, but again, doesn't mean a whole lot to the bank. Other than they might say, we want to try to bring that over to our bank or something. So the other assets. So a lot of times you're always going to go to, real estate. Do they have other real estate owned or personal residence? And then you go to other assets and you say, well, what are his other assets, right? And he doesn't really say, okay, because you kind of look down and go, well, gosh, you don't really tell me what your other assets are. Now, what this, and I personally block this out, but a lot of times what that'll be is it will be the net worth of the business or businesses he or she has. Okay. So, because remember that the business has its own assets and liabilities, okay? Henceforth, a net worth. And then that net worth from an accounting perspective should end up on your personal financial statement, okay? So he's valuing his business at $4.2 million, okay?
And that's only the portion that you have ownership of, correct? So like if he has 20% of the business, okay.
100%. If he only owns a percentage of that, then he would only, take through his pro rata share, right? So if he had a partner in there and he was 50-50, technically that 4.2 should really, exactly, should be 2.1, or you might say, is the 4.2 mean the business is worth 8.4 and you're 50%? Or is it your 2.1 and right? So yeah, exactly. So good. So yeah, you want to look at the asset side and kind of hit on things. If you see accounts receivable, what do you think that could possibly mean? Any ideas?
Accounts receivable, that's going to be if they've accounts receivable, if they've like loaned out money or lent money to someone.
Spot on. If they lent money to somebody, again, could be a family or friend. Not a good idea, but could be, right?
I wouldn't do
it. Or it just could have been like a notes receivable where somebody lent money against a piece of real estate to somebody, and it truly is a true note receivable, right? So good to know that. Life insurance, when you deal with that, notice it says in kind of the quotations,
cash surrender value.
Okay. So when you deal with life insurance, you really have two types, okay? You have term and cash value, okay? Term is really just this. It says, look, I'm going to do a 20-year term deal. You're going to pay, it's pretty cheap. You get $2 million. It costs you $1,500 a year. And if you die, then, for the next 20 years, you get this bucket of money, right? You could get $2 million, okay? If you die. But there's no really cash surrender value, meaning it doesn't have any value other than if you die, okay? Mm-hmm. Cash value actually is more, you probably pay more for it, but you're building up this cash pool, okay, of literal cash. So there's this value associated every year that keeps kind of expanding. And it could be a 2 million policy, but you could have built up, $100,000 worth of cash, okay, that has been put in this sort of bucket of an insurance policy. And so if you ever wanted to surrender it, okay, or liquidate it, then there would be an actual cash value before you die, like you're not even dead, and you just say, I want to end this policy and get my money, okay? So that's what that means, and that really only has technical value on a balance sheet. There's really no way to put it as an asset, the million or the $2 million life policy that's a term, because it really only matters if you're dead.
Yeah. We're not hoping to use that.
Exactly. You're like, I don't want this to really have value, but it's there just in case. Other real estate owned, again, that's just going to be other commercial property. But always remember something that's really important on a personal financial statement, because you will deal with this all the time. People will always intermingle their personal and business assets on this thing, okay? Where they're going to put on here, the commercial property they own on this sheet, okay?
But that belongs to the business, like in an instance.
Yes, exactly. If it was done properly, if it's done the right way. Now, there's some arguments, like if you own it yourself and it's an LLC, technically it should go on your personal, because if you don't have two partners, you don't have an operating agreement. So you could make the argument, but generally speaking, they want to keep it separate. So if you file your own balance sheet and your P&L for that LLC that owns the property, then it should be separate. Okay. And the only thing you should pull through should be exactly spot on. So, so that's kind of just something you're going to see patternistically. People do it all the time. And a lot of times, if it gets overly complicated and they've have a really I don't ask them to redo it, but if they're like newer, then I might say, hey, you probably have to redo this. Okay. So the on the right side, liabilities, right? All the debts, credit cards, pretty straightforward. Accounts payable, same thing. Something that they borrowed money from somebody else, or that could be lines of credit. So a lot of times you might have to ask, what does that mean? Okay.
What do you mean lines of credit? Like not like a credit card?
Yeah, so you could have like a credit card, but then you could actually have an actual line of credit. Like I might say, hey, I want to go borrow and get a personal line of credit. They kind of act the same way, but a lot of times the lines of credit will be a little bit cheaper, and they don't actually come on a credit card. It's just sort of a line that you can draw a check against and things like that.
Okay.
So they have all these different mechanisms. Like you've got credit cards, a home equity line of credit, a personal line of credit. So that's why sometimes you'll have to ask, like, what is that? If that makes sense. Auto loan, pretty straightforward. Other loans, there we go. Student loans, can go on there. Income or taxes payable, mortgages, liens, things like that. So, and again, if you see income taxes payable, you definitely want to kind of hit a timeout.
Yeah, that'd mean that they're behind, correct?
It possibly could. Now, the reason why I always say possibly is because, if somebody's really detailed, then they might say, well, technically I owe this to the IRS, not quite due yet, but I am going to put it on there as if I did. That would actually be an accurate thing to do. Most people don't have kind of that accounting mind.
Yeah.
But you definitely want to press into that, because if they do have taxes payable, it's not necessarily bad, but if it's gotten to a place where they are behind, okay, and they've gotten into a situation where the government has filed a lien, now we're starting to get into some murky waters, okay? That could kill a deal. I'm not saying it will, but a lot of times lenders want to see that they're on a payment plan, and that there is a clear way that this is going to be paid out. Okay. It's just not a good way to start.
Yeah.
Right. Because the lender's like, why didn't you pay your taxes? And
yeah, you're not paying for that. Why would you pay me? Like, why would I trust?
100%. Yeah. I actually had a client one time, he was behind on his credit card, and he's like, actually he defaulted on his credit card. We found out on the credit report, he was in a meeting with the lenders, and we're all sitting there, and they asked him while I was in there, they said, why did you default on the credit card? And he goes, I just wanted them to pounce out. I didn't want to pay it back. And I'm like, oh my gosh.
You're like, could we have chatted about this like before?
Let's walk out right now.
Yeah, time for us to go. Let's pack up.
Completely dead. So, so something you just need to be cognizant of. Over here, again, you'll just kind of walk through. Sometimes, all this stuff's pretty straightforward. Get into alimony and child support and stuff like that. You'll probably see it on the tax returns, because it's always reported. But, those are things you'll just have to verify and just make sure, especially if things are tight, you might go, hey, is that, how long does that go for? Is there a sunset on the alimony? Just stuff you'll have to get into a little bit. And then, mortgage payments, estimated living expenses. So a lot of times lenders, everybody's different. Lenders sometimes will say, we are going to apply a certain ratio of living expenses for people. Okay. So they might say, we're going to, every person that lives in the house, we're going to slap 12,000 a year. Okay.
Kind of like reserves with the different apartment buildings.
Exactly. So they kind of go, okay, we've got your cash flow. We haven't really, we just don't know, there's some living expense you have, right? Mm-hmm. And we need to apply something so we can truly understand your cash flow. Okay. Because all of this stuff falls under this guise of cash flow. And you're like, well, what does that even mean? Simply put, it's just all the money's coming in, right? And all the money's going out. And what is left at the end, if anything? Okay. And they're trying to figure this out on a personal level. And then they're trying to figure it out on a business level. And then they're trying to combine the two to say, do you look healthy? Okay. Or do we need to fix some things? So that's just kind of a synopsis on the, the personal financial statement. Questions on that or any?
I feel pretty confident with it. Accounting was like my, I did really, really well with accounting and they asked me to tutor and everything. So I do get along with it well. I just need to drill it again and again. I haven't looked at the sheets in a little while, so.
Yes, no, that's really good. No, I'm glad. And so let's do this. Let's just kind of talk about the personal tax returns for a little bit.
Yeah, this is very fresh and new to me. So looking at these is a little overwhelming. I'm like 80 pages.
Yeah, I know. It's the beauty is you won't have to worry about most of them. I'll just show you where you're going to hang out most of the time. Okay. So like here on the tax return, so the 1040 is really just your standard individual income tax return, right? Everybody's going to file it. Sometimes they have an easy one. If you don't make a lot of money or it's really simple, they just do kind of a quick short form. But the things you look at, name, social securities, obviously these are all covered up, but dependents, they have any dependents, kids, things that people that are dependent upon them. But down here, you just start going down the line. Okay. And you start looking at the things that are going to matter as it pertains to the cash flow. The first one is their W-2. Okay. Now, if they're a business owner, they should W-2 themselves something. Okay. But what you'll see business owners do a lot of times is they'll just do draws or distributions out of the business. Okay. But, in this particular case, you can see that, they have about $217,943 for their personal W-2 income. Okay. So that is the money that comes to them personally and will be found on their W-2s. Okay. Now, what you might have to do sometimes is go back and look at their personal or the business return just to see, have they pulled that out as a salary? Or if they have a spouse, do their spouse have a job as well? Mm-hmm. So you'll try to just maybe verify that sometimes and go, okay, who's who's making, the money, or is they both working, or is one person working? So you just sometimes need to find out the reason why, and this is really, really important. What the institution is going to spend most of their time focusing on is what they would consider repeatable income. Okay. So this is income that is going to be happening on a repetitive basis for the next little while. So let me expound upon that. So if all of a sudden I go down to this section right here in line 13, and it says capital gain.
That's not repeatable income, right?
Now here, this is where it gets a little tricky. The answer is
unless it's like their business.
Yeah, 100%. Yeah. If they're in the business of fixing and flipping homes, okay, and that's what they do all the time, then you could definitely make the argument like, hey, this is repeatable income. This is what they do. Okay. And so that is definitely an argument. But if you look at the last 3 years of their tax returns and you see 500,000 in 19 and then nothing in in 18 and 17, then you're kind of like, well, that's a little bit tricky. That's a hard argument to make for somebody having repeatable income. Okay. So capital gains, I would tell you 90% of the time is just not applicable. It's nice, but they're not going to really consider that cash flow. Okay. So that would be an example of that. Then you go down to like tax exempt and then qualified dividends. So when you look at 2A, 3A versus B, okay, only difference there is just one's taxable, one's not. Okay. So you can see the tax exempt side on the A side, taxable on the right side. So you just, you'd have to delineate between those two. And again, on almost every item, Lana, you're going to go, okay, is this repeatable? Like, is this
where did this come from?
Exactly. Like, are you getting this every year? Right? So a lot of this stuff verbally, you're going to be having a discussion with them going like, hey, is this something we should expect to happen? Because you still might look in the past and go, well, I haven't seen it in the past, but they may say, hey, well, you're right, but it is going to be happening in the future. Right? So, okay, cool. And we definitely want to credit them as much as we can, okay, with the income. Same thing, you go down to IRA and pensions and annuities. This just goes back to, because like if they fall below, I want to say it's like 67.5, it changes every year. But at some point when you hit a certain age, you're forced to start taking distributions, okay? The government says you got to start taking money out. So if you start seeing that, you might ask the question, hey, was this just kind of like a one-time thing, or are you going to be doing this every year? Okay. And then you can ask that question as well. Social Security benefits, same thing, right? Once they hit a certain age, those Social Security benefits can kick in. And again, that definitely, again, 95% of the time will be repetitive. The only time it gets a little bit murky is if one of the spouses passes away, then I think the government has kind of I don't know if it's a phased out or a portion of it that you might get, that you get to keep from your spouse, and there might be a sunset on it. I'm not sure, but
what does a sunset mean?
Yeah, sunset basically means that like it's going to happen for a period of time and then it's going to end.
Okay.
Right. So just think about like your sun comes up and then it's going to kind of come down and end. Okay. So whenever you hear sunset, that's what we kind of mean is like it's probably going to come to an end at some point. Now on these newer returns, it's kind of wonky. I don't know why they did this, but I don't even like it, but whatever. What are you
gonna do?
Yeah. they changed the format. You'll look at the history ones and like everything's on this page. Now, for some reason, they've kind of pushed everything to here. So all these categories that used to be up here are like here, which is fine. But, you know, taxable refunds, again, probably not repetitive, right?
Yeah.
Alimony received, again, that's probably repetitive. So again, that's something you want to press into a little bit and go, hey, should we expect that's coming all the time? Business income or loss, again, you're going to pull down. Okay, a lot of times, I don't know if you'll have it on here or not, but if you see that up here, okay, so when you look at this item, so business income or loss, C or CEZ, you're going to go down to, and I don't think he will, but we'll see. A lot of times they'll have a Schedule C where they'll put their, yeah, so he doesn't. So if you see a number there, then they'll have a Schedule C, and a Schedule C is basically, it's kind of like its own business tax return, okay? But because it's treated as a sole proprietorship and not its own entity, they put it on the personal tax return. So let's just say Lana wakes up and says, I'm going to have my own dog sitting business, right? You know, Kelana's dog sitting, right? And you're like, you know, I'm just going to kind of do it as it's fun. And I'm just going to do a sole proprietor. I'm not going to set up an LLC. I'm just going to kind of do it and, you know, whatever. So what would happen would your accountant would probably say, okay, well, let's do this. Let's log it onto your Schedule C, and they'll show income and expenses and things like that. We'll keep it really simple. And then that number, that net number, will come back up into line 12. And then that will be considered income. Okay. So it's kind of the same as having your own tax return, where the net income just comes back to your personal. Because remember, the rules are if you have an LLC, limited liability company or corporation, what that means is the taxes are going to flow down to you personally. Okay. Does that make sense? So when you see somebody's LLC tax return, okay, like a 1065, what's going to happen is that net income will flow down through K1 distributions to the individual partners. Okay. So they're not going to get taxed at the business level. They're going to taxed at the personal level. You tracking with me on that? Does that make sense?
Yes.
So now if they have a C Corp or C corporation,
business level.
Yeah, 100%. So a lot of times you'll hear they don't, and the reason why people have loved the LLC is because they don't get double taxed. Okay, they get taxed up here at the C level, and then they get taxed on the personal level. And it's like, well, gosh, getting double taxed. Okay, so that's just the distinction to understand between those. Okay. The other thing to notate is that capital gains, you're going to find the details down on Schedule D, which is going to look, assuming they have it, I don't think they might have it down here, but it should have its own schedule, okay, where you're going to look at losses and income and things like that, but so when you see that, you're going to go looking for a schedule. Okay. So you'll always look for a schedule to see like what was that, income and what was the loss just so you can understand it and go, what happened, you know?
Getting the story for everything.
Yeah, there's always just a story behind all these things. And so you're just trying to understand. This is all just painting a picture. You know, it's like what happened, what's going on, and you're just trying to uncover it. You're like a little PI, private investigator.
Doing some detective work.
Yeah, some detective work. Other gains, losses, again, 4797. You look at the attached, find out what's going on. Rental real estate, royalties, partnerships, S Corp. Again, that's Schedule E. So you'll go down here to Schedule E, which will be right here, where you're going to look and it'll show you like the name of the company. It'll show you, you know, right here, you can kind of see that number, right? Where it's like the 614,509. Come back up there and you see, right? 614,509. Okay. So it ties, and you say, well, gosh, they made 614,509. Well, not so fast. When you go back to their corporate tax return, okay, there might have been a bunch of depreciation on that lowered, okay, that number that came through was 614,509. So their cash flow technically is higher than the 614. Now their taxable income is lower, okay, and so that's kind of the nice part of the tax side. But you're looking at cash flow.
Yeah, so we have to take out depreciation, amortization, and then we have to like move interest back around.
Correct. So you're going to kind of go back and go, okay, was that number? Because if 614 only came through and you did have a bunch of depreciation, you might actually have had more like 800,000, right? Because they just deducted the depreciation, but maybe not. We don't know. And so that's just something to notate. The Schedule E also could be that they have a bunch of rental properties, okay? And so what'll happen is there'll be actual schedules showing the income, expenses, and net income of those properties. And you're going to have to go through each one of them. Done. It's an exercise in brain damage sometimes. I've had clients who've had like 50 properties. Okay.
Like, do you have to have this many, or are you sure that you have like enough ownership of each of these?
Do I really want to go through this? Right.
Yeah.
So you have to go through each one, because again, each one has its own like mortgage, interest expense, depreciation, right? So I have to add each one of those to get back to cash flow. Okay. Because again, I'm trying to get to cash flow, not just what is it showing me here. Okay. And so that's part of this journey, is just kind of understanding what are the important mechanisms. Most of the times you won't have that, but every so often you have a bunch of like, you know, rental properties. And if they do, usually a lot of times it's like, you know, a couple of things here and there. It's not a big deal. So again, you know, partnerships, royalties, trusts, you know, Schedule E, et cetera, et cetera. So that's one you're going to probably see a bunch. Farm income, I think I've seen that maybe one time. Okay.
This is my neighbors. I live in the middle of nowhere, so it's all my neighbors.
All of your farming neighbors, they've got the farming income, which gets all sorts of benefit, you know, from the government. So, but honestly, you probably won't run into it much at all. Unemployment compensation, again, probably not going to see that a lot. Other income, there might be something on there. There could be gambling, something like that. I mean, it's, you know, you'll see some once in a blue moon things. And then just adjustments to income, again, you know, good to understand it, but not going to be a huge deal for you, because again, you're focusing on cash flow. And if there are deductions, it's just a tax deduction. You know, it's kind of like if you have an HSA, right? and you set up a health plan here and it's an HSA, and you can put, X amount in the HSA, and, every year you spend, whatever it is, then you get to deduct that from your income. Okay. So little things like that, but we won't really pay attention to it. Won't give much credence to it, because again, it's just, something to do. So that's kind of how you'll look at that. And again, you're going to spend most of the time up here, and then you'll sort of pop through to schedules. Okay. You'll go down here just to see like, okay, are there any other things that I need to be aware of? But this is the places you'll kind of hang out. Okay. So when you see 200 pages, don't freak out.
Yeah. Yeah. And once I have it kind of like set in my head, it becomes like a puzzle. Like, so then it's kind of fun. I'm like, oh yeah, this goes here.
Exactly. Now on the taxes, okay, you're going to go up here because part of your cash flow is to kind of go, all right, well, what was your taxable income? Okay. And you can kind of see down here, you start to get into all of his taxable income right here. And then the tax 235,011. Okay. And then you go down here to subtract 12 from 11. Okay. If it's 0. So there's all this weird basis. Total tax. Okay. Right here, 235,015. Federal income tax withheld from the W-2 already, right, was 28,912. Okay. And then you sort of have this Schedule 5, 238, refundable credits, 238. So you can see this 266,912, 16 and 17 is how much he has to pay in tax. Okay. Does that make sense?
Yeah.
But then you can kind of see here that this is how much right here that he's going to have to pay as a difference, right? Between this and this.
Yeah, that looks a lot better for him, I'm sure.
Much better. So the important part of that is to say, okay, well, how much, because if you really look at cash flow, taxes become a big deal because you're literally going to cut a check for a lot of money, potentially, maybe not. If someone's making money, they're going to pay taxes, right? So as much as we don't like it, that means you're making money. And so you always have to pay attention to that because you're going to have to deduct the taxes that they paid in order to get to true cash flow. Okay. And so that's an area that's going to be important. And sometimes you'll have to kind of, again, get on the phone with them and go, do I understand what's going on here? So does that make sense?
Mm-hmm.
Okay, good. So what'll happen is you're going to go through these scenarios, okay? And, what I've done is I put together all the answer videos. So I want you to like go through and just muddle around with it, right? Do your best you can. And then when you're done, you can kind of go through the answer ones so that it'll kind of walk you through the answers of the deal. Okay. And so that's what I want you to focus on when you go through these on the personal side. Okay. Now on the business side, okay. Well, before I go, any questions about that or anything I can?
Yeah, I think just kind of messing around with it will get me where I need to be.
100%. It's just diving in. Okay. Now on the business side, again, we kind of go through, this is where you're hanging out most of the times. Okay. Oh, by the way, another thing to notate too, when you do the personal and you get the personal tax returns, you're always going to ask for K1s. Do you know what I mean by a K1?
Oh gosh, I have the note of it, but
it's okay.
I don't think I can remember off the top of my head.
Totally fine. So the K1s are basically the distribution document. Okay, so
Oh yeah, it shows how the corporation is like split up between the people who own it, right?
100%. So it'll show you like who owns what the percentages are, how much they took out of the company for that year. So that's a huge number. That's a huge thing you'll need, and the bank will need, is the distribution amounts. Okay. So you'll definitely want to make sure when you get tax returns that you are asking for Schedule K-1s. And the reason you have to ask for it is because a lot of times the accountants will not send them all together. They'll just send you a tax return, and then you need to ask for Schedule K-1s as a separate item. Okay. So just something to just remember, because K-1s are like a really big deal for cash flow for the lender. And so you want to make sure you get copies of those. Okay. All right. So on the business tax return, you'll notice that this is a 1120S. An 1120S it's a corporate return, but it is an LLC, okay, limited liability company, but it files as what's called a subchapter S Corp, okay? All that really means is they don't get taxed on certain levels of income. It's just kind of a little strategy that they do. And so we do a subchapter S corporation, and there's just certain little tax benefits that you don't get kind of double taxed on certain things. And so it doesn't really mean a whole lot to you or I, but this is really for an LLC. Okay. So you'll go through and you'll look at the gross receipts or sales. It's always important to maybe take a look at, when were they incorporated? It's a good place to just take a peek, see how long it's been around. Gross receipts or sales. And then you want to look at cost of goods. Okay. So what do we mean by cost of goods sold?
How much it costs to, let's see. I can't really think of another word for that, but how much it costs to produce what they're producing, or provide their services, or provide the products that they do.
100%. Yeah, like if you're a manufacturer, then there's a certain cost of that sale. Like you literally have to make the product and sell it to them. So what's the cost, right? Because you're trying to figure out what's your gross profit, or sometimes they call gross margins. And so in this particular case, they're probably running at about a 33% gross profit, right? And so it costs them $2 million, 2.1 million, and their gross profit is about $1.1 million, give or take. And then, what's the other income? What's the total income? What I try to do is be really cognizant of year after year after year. Like, are they trending a certain direction? Okay, so the first thing you want to look is, like, when you get those 3 years of returns, you always want to start going, okay, is this company moving in like the positive direction, or are they going the other direction? And then again, because you're a detective, you're going to say, what's going on? Mm-hmm. And then they'll be able to tell you, hopefully, a good story, right? Well, here's what's happened. And, and so hopefully they're moving this direction, okay, in the positive direction, as opposed to the other way, because the bank's going to look at that and go, why are you losing? Why are you going this way? Okay. Mm-hmm. Your sales going down. Okay. Compensation officers, right? Just pretty straightforward. Salaries, wages, repairs and maintenance, bad debts, rents. Remember the whole rent discussion, what you're always going to look for in rents. What do you think? When we see rents, what are we going to press into to try to find out?
We're going to be asking if they're going to be moving from where they're currently at once they get this loan and go somewhere else, or if they're going to be continuing to pay those rents.
100%. Yeah. You're moving, staying? Do you have
Expanding.
locations? Yeah. Do you have multiple locations? Right? Like, do you have like 3 or 4? And the other question to ask too is to say, is this rental for equipment?
Mhm.
Because, that could possibly be some of that number. So you're just trying to find out how much you need to take and delineate, add back versus not. Okay. So rents, taxes, license, interest. Again, interest is just something, again, you're going to add back in because it's going to come out in that debt payment already. Okay. So you're trying to get to remember that fun little word EBITDA, right? I told that to my daughter and she's like, EBA, what? I said, EBA. So that EBITDA number, earnings before interest, taxes, depreciation, amortization, is that number you're trying to get to up there. Okay. Depreciation, you can see they don't have a lot of it. It's a law firm, so they're just not going to have a lot. Actually, this is
no, like equipment to be depreciating.
100%. Yeah. And then you've got depletion. Do you know what depletion is?
I haven't heard of that.
Okay, so depletion is, again, you probably won't run into it a lot. Once in a blue moon, depletion is this. Let's say Mr. Cotter had a lumber yard. Okay, so I have a huge forest of trees and I have a huge lumber yard. Okay. What they're going to do is they're going to run this accounting calculation to go, how big is your forest and like how many years before you're depleted out of your resource, your natural resource, which is your trees. Okay. And they're going to use some calculation to use depletion. And it is almost a synonymous thing to like depreciation, but it's just on
actual tangible things going away.
100%. Like for example, it was like a rock quarry company where they had all this like mines, they'll just basically rip out dirt and, sell rocks, and that's definitely, they go through this whole calculation and go, well, you have this much land and there's this much dirt and
eventually they're not going to be there anymore.
It's not going to be anymore, right?
Mm-hmm.
And so the smart guys kind of figure that out and then it'll go on here. But again, just so you kind of understand.
So that would still get added back in though, because it's not a cash.
Yeah, correct. Yeah, 100%. Advertising and pension, employee benefit, Now you get down to the total deductions and you get to this thing called other deductions. Okay. And remember that when you see that, it says see statement. Okay. And you want to go down there just to check, make sure there's nothing in there that you go, well,
why? Can be the like, why is this here?
Yeah, why is that number? So you see this 172, and then you're going to kind of just take a scan through it. And what you're really looking for is like amortization. Okay. So that's sort of a number that you're going to look for. Okay. Otherwise, it's not applicable to you. Okay. Then you pop back up here and you finish off to get to your net income. Okay. So that is just kind of an overview, right, of personal tax, business tax. But what I want you to do is I want you to go through the exercises. Okay. It's kind of got to get reps. And then when we come back next time, what we'll do is we'll walk through that together and we'll start just answering those awesome questions that Lana always has. Okay.
Yeah, I'll come with a full notebook, I'm sure.
Yes, 100%. So